Good afternoon, and it's a pleasure to having you here with us. Welcome. Let me first of all say welcome to our webinar series on how to succeed on this new normal. And like I said, to welcome you on behalf of Wichita State University and the KSBDC. The purpose of these webinars, this workshop, is to address issues that are going to help business owners to hopefully get a leg up on these uncharted territories that we're about to cross, or we are crossing already, started maybe 6 weeks ago or so, and moving forward. Um, we had the managing business as unusual last Tuesday when we talked about a lot of different things that we needed to learn and analyze and discuss in regards to the new normal in general terms. Today, we're going to be focusing on how to develop maybe a 90-day cash flow so we can have a good benchmark, a good idea of what's going forward. And this uh, short cash flow can help us to figure out if we are on the right track or if we need to pivot or adjust, or what are some of the things that we need to do. Um, the title of today's workshop is Sink or Swim and Cash Flow is King, and which is a reality in business, and we know that as business managers, business owners, that without cash, things in business and in life a lot of times are difficult. Let me just take care of a couple of housekeeping issues. We have Emily with us on the wings, and at the bottom of your screen, right there, there's a chat box. So if you have any questions, please go ahead and post them for all on the chat, and Emily is going to be collecting these questions. Uh, Typically, we find a few questions that are similar, so she'll be grouping these together, and we'll have about 15 minutes, 10 or 15 minutes before the hour where we can address some of these questions. So again, thank you so much for joining us, and we'll go ahead and get started. So welcome to Sink or Swim. Cash flow is king. Let's go to the next slide, and we'll look at some of the key things of cash flow. Cash flow is one of those terms that we use in different ways. It's an accounting term, but we use it in business lingo as well as the colloquial, and it has different meanings for different people on how it's being used. We're gonna talk very briefly about what does it really mean in your business and also in accounting terms, and why is such a key piece of the accounting documents, and how you should be able to uh, develop one, or direct your accounting person, your bookkeeping person in developing one, and more important, how to interpret her. So right there in your slide, you have some definitions or some of the things about cash flow. But just remember, cash flow and profits are not necessarily the same. Although a lot of times, especially during business transactions, buy and sell businesses, cash flow is used almost as profit. And really what a lot of people mean is positive cash flow. What is the positive cash flow that the business owner is able to use? But normally they just say cash flow. But the key thing that we need to remember is that this positive cash flow is what allows a business to survive. It allows a business to grow, to um, finance that growth, or to support or service the debt that the business may incur in order to allow that continuity or allow it to grow. So cash flow is to the business what the bloodstream is to the human body. I mean, there's a lot of organs, a lot of things that have to do on how we function, but without that blood circulating in a healthy way, the body suffers to the point sometimes of death. So it's the same thing for the business, and we're going to be looking at some of this. If we go to the next slide, please. Um, Again, a little bit of the same. These are some of the things that the cash flow does. It allows the business owners, allows the business to generate profits. It also allows to build up reserves. It allows to finance assets or to retire debt. Cash flow, it's a very key indicator of what the financial health of the business is. A weak cash flow or a negative cash flow, immediately it's a business, it shows a business that is not healthy. There are some caveats to that, because at times during the different accounting periods, there may be a negative cash flow, and we're going to see some very specific examples, but that's precisely what we need to learn how to forecast, how to create a pro forma or a cash flow projection in order to understand what could happen if there's going to be at times during the accounting period, during the business transactions period, that we're going to have cash flow less than optimal. So that is important. Let's go to the next slide as well now. We are going to talk about how to build a cash flow projection. But in order to do that, let me give you a very quick overview of 3 important financial documents that every business owner, every business manager needs to be able to read, interpret, and use them to make decisions, strategic decisions on behalf of the business. These decisions are not always financial decisions, but indulge me and let me take you very quick over these 3 documents and why are they important. And we need to understand them in order to be able to build the projections, the cash flow projections. Because as you know, accounting, as opposed to finance, accounting looks at financial facts of the past. It's a historical view of a business, okay? Finance is the analysis of those accounting documents, of that accounting information, in order to provide with decision-making capabilities to the decision makers, to the owners, to the CFOs, or to bankers, or even the IRS, to analyze what happened in that accounting period. So it's very important to understand that. I'm personally not a CPA. I'm not an accountant. My background is finance. My master's is on finance and marketing in business. So I am not an accountant, but nevertheless, I've learned to generate some accounting documents, but more important, to interpret them. So we're going to talk about 3 documents, 2 accounting documents that are important and key in order to build the projections. Number 1 is the balance sheet. The balance sheet is, if you would, a photograph, a financial photograph of your business in a point of time. That means is exactly that, a photograph, okay? It's just the way it is that day, that minute that you took that picture. And it shows the assets of the business, which are all the different things that the business has in order to conduct its functions, okay? It has the liabilities, which shows what part of those assets somebody outside of the business may have a claim on, okay? So a banker or a creditor or somebody may have a claim on part of those assets. Those are called liabilities. And then you have equity, okay? And or owner's equity. And basically that is the claim on the assets from the owners of the business. So assets, liabilities, and equity. Those are the 3 key pieces on the balance sheet. I mean, assets can be split into current assets and long-term assets. Any current asset is something that is cash or something that can be converted in cash in a fast way, inventory and things like that, okay? Same thing with Same thing with liabilities. Some liabilities are short-term, like, you know, maybe some of the accounts payable that you pay every 30 days, or things that, you know, will be retired quickly, like payroll taxes and things like that. And long-term liabilities are notes payable that go over the accounting period of 1 year. And then the equity, of course, is the difference. Okay. So if you think about your own house, for instance, a house is the asset. Whatever the balance is that the mortgage company is holding, that is the liability. And the part that you have paid on, you know, it's your equity. So very similar. Just think about the balance sheet in those terms: assets, liabilities, and equity. The second document is the income statement. This is key, even more important in order to build your cash flow projection. The income statement, if the balance sheet was a picture, a financial picture of your business, it only looks that way that day, you know. The income statement, or P&L, is also called P&L, profit and loss statement. It's a video of the financial performance of your business. Okay, it's a video. That means it's got a beginning and it's got an end and it's got activity in the middle. Okay, think about a basketball game. There's a home team, there's a visitors team. There's different you know, things that are counted, whether they're rebounds or free shots or inbounds or takeaways or whatever, and there's points that are being scored. Same thing in the income statement of a business. You know, the home team scores points, and those are called revenues or sales or income. They don't mean the same thing, but for the purpose of this workshop, basically money coming in. Okay, so revenues, sales, income, you know, is points score in favor of the business. The visitor team scores also, and those are called expenses. These are monies that are going out to cover certain things for the business to function. And there's a winner and a loser in this game that we are talking about. Okay, if the home team scores more, that means there's more revenues coming in than expenses going out. There's a profit. That means the home team, the business wins. If it's the other way around, well, there's a loss. The home team is losing because the visitor is scoring more points. There's more expenses going out. Okay, so at the end of the accounting period, then you're going to have a winner and a loser, or a loser. You know, either the business is going to win or is going to lose, depending on what is that difference between, you know, revenues and expenses. So this is really important. Speaking of the accounting period, accounting periods basically are three: monthly, quarterly, and yearly. Okay, and you can see here historically what are some of the things on your slide up there. What are some of the things that the monthly, the quarterly, and the yearly periods show you, and why they're important in its own way? Mainly these three terms are determined because of the general accepted accounting principles. GAAP says that. And second, because we report our financial performances to the government and to some of our creditors, to the bankers, and for ourselves. And it says those are the three periods in which they are done: monthly, quarterly, and yearly. Okay. The third document is the cash flow statement. The cash flow statement is basically very similar to the income statement, with only one exception. It measures the money coming in only in cash terms at the point that cash is converted. Okay, that cash hits the bank account or the cash register. Otherwise, is not just the sales, but the actual cash in the hands of the business. So that is the difference. And all these things are recorded in the past. Okay? So in order to build our projections, we need to look at this historic information. We need to look at what else is happening in order to develop them. This is very, very, very important now. And let me tell you, most of your cash flow projections are not going to be on the dot because, again, these are uncharted territories. Things have happened that have affected the way most of us do business. Nevertheless, unless you have a benchmark, it's going to be very hard to pivot. It's going to be very hard to adjust. It's going to be very hard to correct and take the actions that are needed in order to allow your business to go forward. So we're going to look at this. If we go to the next slide, please. Okay, so we're going to be looking at 3 different types of cash flow projections. We're going to look at a business that is a retail business, and it conducts all their sales on cash. Okay, this is the simplest one to do, the simplest one to manage, and the simplest one. And don't get me wrong. I mean, there are certain things like inventory control or supply chain availability of raw materials, and some of these things that can affect this, and that are not necessarily financial issues, but that will be reflected eventually on your cash flow, and it'll be reflected on your income statement. So we need to pay attention to that. The other business is a business that typically invoice their sales. Okay, that means there's a lag between the time where they finish the product, pay for all the production costs, and the time that they receive their money. This is very tricky, and it's very important to be able to build a good cash flow projection in order to manage this, because the influx of cash and the expenses sometimes can get a business in trouble, especially if things have changed in their environment. So we need to make sure that we have projections in order to do that. And the last one is going to be also a retail cash business, but with a very marked seasonality. This is also very important because even though all their sales or most of their sales are in cash terms, the influx of those sales varies throughout the year, throughout the accounting periods, and therefore the seasonality can really affect this business if they don't prepare to do that. So that's what we are going to be, that's what we're going to be looking at. One last thing, you do need to do a market analysis. Listen, you need to understand the importance of profiling your customer, of understanding the changes in your environment. What are some of the things that will change, have changed, and how are they going to affect the way that cash comes inside the business? So finance in a business, the accounting piece or the projections piece, whatever we're talking about today, is not in a vacuum. You need to look at your operation. You need to look at your labor. You need to look, more important, at your customer and at the market. Is your product still viable? Is your service still viable? Is it more viable now than ever? Or has it suffered? And if it suffered, what are you going to do in order to adjust? That's why we're talking about cash flow. Because if you run out of cash, you run out of business. Okay? So all these things come together. We're going to go ahead and take a look at an income statement. Okay? Next slide, please. Okay. And this is the income statement for company XYZ. As we go forward, you'll see who is X, who is Y, and who is Z. Very, very simple. Okay. I hope you can see my cursor here. So what you have is it's a 3-month income statement. Okay. This is either in the present or very much or close in the present or the past, because these are actual transactions that took place. Okay, so let's say this is the end of the first quarter. Okay, March 30th. All right. Okay, so this is what we're looking here. Here you have the 3 different products that they sell, whatever they are, and those are the total sales for the month. And thus, at the end right here, you have over here a name that is called COGS. And I'm sorry, that should be a C. The very first one should be a C. It's COGS, COGS, okay? And stands for cost of goods sold. So these are costs that can be attached directly to the sales. If you don't have a sale of that product, those costs are not incurred, okay? Those are called direct costs that can be attached to the sale, all right? And you don't see it here, but that's a 5% of sales is how that amount was derived from, okay? And the second one is 8% of the sales. Typically, those are very low COGS. Most COGS are higher than that, but you know, sometimes in some industries you find that your COGS are a relatively small percentage of the sales, and others ones they're much bigger. So this is just an example so you understand that. So these two numbers typically come from a percentage of the numbers here. In some places, it's a lot more complex than what I have here. You would have different product lines. Let's say that you're a convenience store. You have all your beverage, you have all your snacks, you will have all your hot foods, you will have your fuel, you will have all these different things, and you will have also different COGS for each one of the different product lines, unless they're not the same. So just remember, this is just an example and get you familiar with some of those terms, even if the guy here misspelled it, and that would be me. So you have these numbers right here. Then you come to the general and administrative expenses. These are expenses that typically you will incur in the business regardless if you have any sales or if you sell everything out. These expenses will take place, okay? All these expenses that will take place regardless, just by the virtue of being in business, you're incurring in these expenses. So in some companies, your COGS is going to be a lot more than your general administratives. In other ones, it depends on how it flows. And in other ones, the general administrators will be more expensive or will be higher than the COGS. There's not a general rule. Those differences come by the industry, okay? So let's look at what of these expenses are here. And you'll see that they're the same every month. That doesn't really happen in real life, but especially the utilities one, and you may have a completely different type of, line items here, different accounts, but this gives you an idea, okay? So you have payroll expenses. Now, payroll expenses is only the piece of those FICA and all those contributions that the business pays into. So it's not everything, because when you write a payroll check, some of those deductions in that check don't come out of your pocket. It comes out of the employee's pocket, right? But for instance, all the FICA comes out of, you have to make those payments. So that usually will be a percentage of the payroll. I think here I use 15%, okay? Well, the deductions, if somebody is contributing for a 401k, or if they're paying for their health insurance or something like that, they may be up to 32% of their paycheck that gets taken out. But the business portion is the only one that goes into the payroll expenses. The employee contributions, you don't reflect them in here, okay? Then you have utilities. And typically you can put this also in relationship to sales. What's the percentage of sales of that expense? Like rent, that will be close to 8% of the sales. Your vehicle expenses will be about 4% of the sales. And the total of all those things, including your profit and loss, should total to 100%, which will be the equivalent of the sales for the period. So as we go down, we find out that we have the total of the general administrative expenses. So we have the total expenses, which will be your COGS. Remember, Oh, here we got it right. COGS plus the JA, and those are your total expenses. So your profit and loss will be the difference between the sales and the total expenses, okay? And this is what happened on the first quarter, right? So here you have all the totals, all total sales, total COGS, total GA, and the total profit, okay? Now remember, this has already happened. So now we're gonna jump on the art, if you would, or onto the skill of developing a cash flow so you can make strategic decisions based on what those projections are telling you. So now you're looking at the income statement. You may want to look at last year's second quarter income statement, or you want to look at the whole last year income statement. So you figure this out, and then you look at, okay, what's happening in my market, okay? Let's say that you are in the group of businesses that will not be able to open until May 18th. There's some businesses that were allowed to open last Monday, right? And so you got 2 weeks into the next quarter, let's say, or into the next month, that you're still closed. And you still may have some of these expenses, but you don't have any of the sales, unless you can maybe do some online sales or something like that. But typically, if you're not allowed to open until the 18th, is because you're in one of those businesses where social distance or some of those things are still a concern, and so they've delayed that opening. So your cash flow projection is going to reflect that challenge, okay? So you look at the past history of your business, how does typically your business has functioned, and then you bring in the new or the future or the market analysis that you have done, and combining these things, you know what you're going to try to project what those revenues and expenses are going to be. Some of those, you know exactly what they're going to be. Your rent hasn't changed. Your utilities may or may not have changed. You can see a difference there, and a lot has to do with the weather, or, you know, if you use more air conditioning or more heat or whatnot, different things. But when you look at your past, you know, income statement, you will see what those fluctuations are, and you will know, oh, I know I pay more there because there were more gas, or there was more electricity, or there was more water, depending on what you, or more internet, or more cell phones, or in the vehicle, same thing, you know. Well, gas right now, it's, you know, $1.25. Well, last year was $2.60. So that was higher last year than it is now. And you understand how those things work, and then you make those projections. Now let's jump into the actual projection, and let's go to the next slide.
Frank, before we move on, we do have a question as to whether there should be a line for purchase 3 under the cost of goods sold category.
Okay. Again, I said this is just an example. In some things, they may be 2 for only 1 product. Let's say that you have 2 types of raw material. So maybe you have a raw material and a procured product that goes in every single unit that you sell. It could be more than 1, even for one of the products, or it can be one that is common to all the 3 different products, and that takes from each one of those. No, this is just an example. The answer is, it depends. Yes, typically there will be at least 3, but maybe these 2 are made with the type of raw material. It's just, this is the large size and this is this is something else, or this is the blue and this is the red, but the raw material is the same. And so you have 3 products, but you have 2 COGS. Or you may have 3 products and 5 COGS, because there's one that brings more products of one or the other. So that all depends on your business. So the answer to you is probably yes, and it could be more than 3. It doesn't have to be 1-to-1. The relationship doesn't have to be 1-to-1. It is what it is. If product 1 uses 5 different procure pieces that are essential in its production, well, those 5 will have to be somewhere there. 5, purchase 1, purchase 2, purchase 3 for product 1. So in a real cash flow projection of a complex business, you may have, 13 products and say product 1 COGS, product 2 COGS, product 3 COGS, and each one of them will have its own list of what those costs are. This is very elementary, more than anything else, to illustrate the concept. Does that help?
Yes, I believe you answered the question. Thank you.
Okay, all right. Very well. Let's jump on the first cash flow projection. Okay, so here is a retail company that also has 3 products. And if you see this, it almost, as a matter of fact, it just basically mirrors the income statement, okay? Because you figured out, let's say that we were in normal circumstances, that this COVID had not affected your business. You could look at the first quarter of 2019 and you could have projected the first quarter of 2020 with some minor variations. For instance, okay, here your product 2, you increased the sales. Why? Because you knew this demand was coming up. You knew that there's more people looking for that product. You knew you were going to have better pricing because you got a new supplier. So you go ahead and project what your sales are going to be, okay? And you put them in there. Now, why did this go from 20 to 15 and this went from 17 to 13 and even more? Obviously, you know some things about your business, and you know that in this month, for this reason or that reason, the sales will go up or it will go down, okay? For instance, a lot of folks know that January is really a bad month for retail. Why? All the buying remorse, all the empty pockets, all the things that happen to the consumer for all the money that they spend during the holidays. Everybody's got a New Year resolution. On the other hand, there's some business that their sales go up in January. For instance, the gyms and diet programs and health food, and those sales go up. Why? Because our New Year resolution and all the things that we do. And then by the time March Madness comes around, or used to, boom, those sales are up or go down. Everybody, same thing in September when kids go back to school. There's no traveling, there's no vacation. There's some things that happen, and we know those things, so we project them. The challenge that we have right now and what you need to do the next 3 months is that you really need to figure out, what do you think is going to happen? Don't worry if you're hitting it on the nail, right? The nail on the head. Don't worry about that. Just make sure that you exercise your knowledge of the business, what you're hearing from your customers, what are you seeing out there, and try to project your sales, okay? And then roll it down just like we're going to do right here. So remember, these were percentage of this right here. These obviously are very different percentages, okay? Now, there is something that you need to notice here on the purchase number 2. It doesn't change. Looks like the purchase number 2 is only tied to product 3. Maybe there is something about this product that the sales are very consistent. 4,850 or 5,210. And so you just average them at 5,000 because that particular product doesn't depend on seasonality, doesn't depend on the weather, it doesn't depend on anything. That product is steady. No matter what you do, you don't have to put it on sale. You don't have to, whatever you do, that product stays right there, okay? So you see that one and that one hasn't changed because you as the owner knows that this product is steady at that rate for whatever reason. Maybe your capacity, maybe you could sell more, but the profit is not worth it. So you just keep it at 5. Maybe it's a loss leader that you have it in there because it brings people in, but that's all it's going to sell. So you know what your product does, what your customer buys, you know who your customers are and where they are and up and down. I mean, right now there's a lot of folks that are on unemployment. So let's say that your liquor store was close to, which is a cash sales business. Your liquor store was close to Spirit, and a lot of folks from Spirit that came out, ate there. Or you had a restaurant close to Spirit, and your lunch crowd was huge. Well, you know that a lot of those folks are furloughed or on unemployment or something, so your sales are going to go down. Now, how much down, you don't know. So you're gonna figure it out, and you don't have to be, on the dot, but make sure that you take past information, costs that and what do you see happening out there, and start from something, and then you will adjust, then you will pivot, and let's go down, and then you go down, and you figure it out. What's going to happen. Okay, so this time your expenses were less, even though your sales were less. For some reason you had a better cash flow, and same thing. So something is happening. Okay, something is happening, and you see whatever money is over here goes to start with the money that is going to be on the bank for the next month and for the next month. So whatever is here goes up here. So sometimes that's why that happens, because what you have in these graphs or in these tables are, okay, so those are your total GA, those are your total COGS, that is your total expenses, and it's very simple. Cash in, cash out, this is my cash flow. Okay? So, and then you have the quarter. Now you would say, Frank, how come the last cash flow of month 3 doesn't reflect what I have here at the end? What was the balance in the bank? You know why? Because you started month 1 with $5,000 that were not generated in this quarter. This came from quarter 1. This is quarter 2, quarter 2, quarter 2. So this 5,000 is exactly the difference between these two. Okay, so that's how you see what your cash flow for the period was on a retail type of situation. Now we're going to complicate things here a little bit, and I'm going to move along to the next slide. Okay, this is very different. This is a company that sells every month, but it doesn't collect all in cash. You have a percentage here, okay? And this is what I have color coordinated this, okay? Let's say you are a manufacturing company, you do this is Wichita, you are air parts, you have a $1.2 million, let's make it easy on my math. You have a $1.2 million a yearly contract with a prime, and you're to deliver $100,000 a month of product, okay? So month 1, your sales are 100,000. Month 2, your sales are 100,000. Month 3, your sales are 100,000. But let's see how the cash flow works. Historically, that you're only going to get, this is the money that you have coming in, okay? Don't pay attention to this right here. Is not accountingly is not correct. It's just to illustrate a point. So don't worry about this pink color right here. Okay? So you start the month with, 30,000. Your cash sales are 10,000. It doesn't matter that your total sales were 100,000, because all you did it's get this much in cash. So your monthly cash in, okay, was 10,000. You have 30,000 in the bank, but what you brought in was 10,000. Your COGS is 25% of your sales, okay? 25,000 bucks, okay? And here are all your general and administrative expenses. When you're said and done with your general and administrative expenses, they come up to $49,000. Well, you came in with 30,000, you collected 10,000, that's a total cash for that you have available, 40,000. Right off the bat, you're 9,000 in the hole that month. Okay, you didn't pay someone, you didn't pay some suppliers, you didn't pay some, you definitely did your payroll. You may not pay your taxes. You might, and that's why things are important. That's why this is very important, because that's how businesses get in trouble, because they don't do those cash flow projections. Okay, if you know on the month before that that's all you're going to have at the end, and you do this exercise, you see, oh crap, I'm going to be almost $10,000 out. So you start the next month with already almost 10,000 in the hole. Okay, again, 10,000 are cash, 10% is cash. You collected, but you don't know if you collected them the first of the month or the middle of the month or the last of the month. You know that 50% of this 100 will come in the second month, right? So you got that. So your cash flow was 60. And again, this was 49,000 are your general administrative and your COGS together. Why do I have 750 here instead of, because remember, I got 60,000. I get 10 and 50, but what? I had a negative 10,000 that I kept dragging. Okay. So really those 10,000 and those 9,250 almost voided themselves. And the 50,000 that you actually got from the first month almost voided themselves with this 49,250. So the actual money that you have here, I think my math is wrong. It should be 1,500. Okay. But my point is, you made very little money here, actual cash flow, assuming that you caught up with some of those bills. Okay. So you go to the next one and the same thing. Oh, no, I'm sorry. Not the next slide. The next column. I apologize, Colton. Thank you. So you see the problem here. Okay. Now, what is this pink right here, and why are those amounts so big? Because this is what exponentially you can be in the hole by month third. It won't happen because you will close your doors on month two. Okay, you will not make it that much when you're that much in the hole. The reality, if you were allowed to function with those shortcomings, you got cash for that quarter, $170,000, and your expenses were $147. So technically, you make it because 170 is more than 147. But in reality, you won because these deficits will compound and will accumulate before you can come here and collect the first $100,000. And that's assuming that your prime will pay you in those terms. Why, if your prime pays every 90 days, or in some cases every 120 days, if they got you in a program like Spirit Producer Own Inventory, where you can go 120 days to get your first check. So even though your sales, even though you're invoicing that every month, you are short every month because this is not the way you're collecting. Okay. So if you had done this and seen this, and you had figured out that you can go to your bank and get a line of credit for 50,000 over here and start with 80,000 instead of 30,000, you would have made it. You would have made it without those deficits. Okay? So in a business that invoices, in a business that is not a cash retail business, cash flow is more important than ever, because you need to figure out at what rate you're going to be getting your cash in order to make sure that you can acquire the difference. Because if you can't, this type of sales that technically are making you almost 50,000 a month, see, those are your total expenses, and those are your total sales. So you're almost making 50% profit on paper. But if your cash doesn't come on time, to, overcome those expenses. It doesn't matter that your profit margin is that great. You're not going to make it, because if you don't have cash in the bank to do the payroll, to keep the lights on, to pay the insurance, so on and so, to pay your suppliers of raw material, it doesn't matter if you have a great margin, you're not going to make it. So by virtue of creating this document, you know how much you need to go get a line of credit or to ask for an advance or whatever. You figured out what you need to do. So this is very, very important. If your sales are going to go down in this scenario, unfortunately, you're going to have to look at some of the things that you can control. This is going to control itself because you're going to be selling less, so your COGS are going to be less. Out of all this mess here, you could probably control somewhat that one. You can control somewhat that one. You can go renegotiate that. Your shipping is probably going to go down too. Okay, your shop supplies are going to go down, but nevertheless, you're going to have to figure out how much you need to make it, because that amount, that schedule of payment is going to hurt you. So let's go to the last one. And I'm going to try to do, let's see, no, the next slide, please. Yes. Okay. Here you said, Frank, I don't have to worry about, I have a retail cash business. Okay. Are you a convenience store? Are you a Quick Trip where it doesn't matter month to month? People have to get gas. People have to, get their lunch there, or this and that, or a pharmacy or something. Or are you, let's say, a Hallmark store, or a swimming suit store, or swimming suit type of, or summer type of apparel type of business, where seasonality really affects your business? Let's look at this real quick, okay? So you enter with cash on hand for $60,000, okay? This is your projection. Or let's say you retail, and let's say the Hallmark store, you just ended Christmas, a lot of Christmas cards for whoever sends Christmas cards, a lot of presents, a lot of gift items, a lot of things. You came out flush with cash, okay? So you got 60,000. Here are your sales. Same thing. Here are your sales. Here are your COGS, okay? Here's your payroll, your insurance, different type of expenses. Here are your total general administrative. Here are your total expenses, okay? So you did well. That month you made money. So when you do the difference and add it up, you go to the first of the next month with $75,000. But look what happened. Look what happened from this month to this month. Your sales just went down because, or let's say this is May, June, July, okay? You had Mother's Day and all those wonderful things that we do for mom. And then you go to June. Not a lot of presents bought at the Hallmark store for dad, okay? So your sales went down, okay? Some of these things went down, some of these things didn't. But that month, your team didn't score as much and the other team scored more. You lost $9,000 in terms of cash flow, okay? But you made it because in the bank, you have enough money because what you came in with and how the sales and the profits of this month or the positive cash flow went into the bank, and you made it. You lost money, same thing. You lost money on the third month of the quarter again. But you have enough cushion to do that. And eventually, you know that you're going to have to go to market in order to have the Christmas, the merchandise for Christmas sales and whatnot, so on and so forth. So this may not be enough. As you do the next month projections, you realize that you're still going to have a couple more months of losses, and that this is not going to carry you, especially if you got to go to market and buy all your inventory for the holidays. You're just going to have to go to the bank and figure out how much you're going to have to get on your line of credit, okay? Because eventually you're going to make it. In this business, 50% of your annual income comes between Thanksgiving and Christmas. In about 6 weeks, you get 50% of your yearly sales. So you forecast accordingly. you make money only 5 months out of the year. The other 7 months, you lose money. So cash, even though you're a retail cash business, the seasonality will demand that you do a very tight cash flow projections to see if and when you're going to need some additional money injected into the business. Okay, last slide, please, and I'm going to wrap it up so we have more time for questions if there's those. Okay, so very simple. These are the things that we need to understand. You need to perform a current market analysis in addition to your accounting history. Okay, you need to find out what's going on in the market, what's happening right here, what is happening in the environment, what is happening with your customer, what are the things that you're seeing that they are going to do to affect your business. Then you go to your historical data from your accounting and the things that you know, and then you figure those next 12 weeks, those next 3 months of your projection. How cash is going to come into my business? How cash is going to go out? Do I need to get, a line of credit? Do I need to sell some assets? Do I need to, or am I going to be okay? Because all of a sudden I'm in medical supplies, or I'm in a type of business that in this new normal is going to take off. Okay, so that's what you need to do. And one of the things that we need to figure out is, okay, what kind of strategic planning is my pro forma, my cash flow projection pushing me to do? Right here, do I need to get a line of credit? Do I need to get a loan? Do I need to grow? Sometimes the line of credit is just to make it to your next season where you're going to make money, okay? Or for those invoices to come in. Okay, sometimes it's a loan because you need to grow your business. You need to expand your warehouse. You're going to get more equipment in order to grow. Okay, what are the supply chain changes that are taking place? A week from today, we're going to have a workshop on supply chain. So you need to figure out if there's some changes there. Okay, are there some marketing changes that I need to do? Do I need to forget that expensive yellow ad that is costing me $12,000 a year, and maybe I need to attend Emily's workshop next Tuesday and learn how I can use social platforms and be more effective and save money? Okay, do I need to tighten my belt? Okay, so those are the type of things that a cash flow projection allows us to do. And number one is survival. Number two, hopefully, is growth and more profitability. Open for questions. I know you were drinking out of a fire hose, but if there's any specific questions or anything that you want me to go back, I'll be glad to do that. No questions?
It doesn't appear that any questions are coming in at the moment.
Okay, I hope that it was, because it was very clear. Somehow I doubt it, but I hope you understand those basic premises. You need to understand your financial documents. You, as a business owner, you don't have to be able to create them, but you need to be able to read them and analyze them and use them to look at the future and make sure that you can create the projections that are going to benchmark your progress in the next 3 months, in the next 6 months.
Frank, we did have a question come in. It is, what are some resources you would recommend to get a view of the current conditions of our local economy?
That is a really tough one. I would say your SBDC, us, is one of those resources. We can try to access some of our databases, try to do some market research in terms of consumer behavior mainly. We can look at some prices of things that are taking place. You can look at your particular industry. If you are in the health and wellness or beauty and health or food service or pest control, or you are in the manufacturing, specific, let's say you're industrial ag or you're aerospace. I mean, I don't know. I would look definitely to databases that get information on your current business. Search as much as you can. Start on Google and move up. Your local libraries have access to other databases, business databases that will allow to look at those things. But yes, there is a great deal of uncertainty right now. So try to be as accurate as you can, and you got a sense for your customers. You do, and find out. I mean, if you have a good customer, but both of the people in that household got laid off, you know they're going to be cutting back. So, is my product or service essential or is discretionary? Is it something that people can cut and don't worry about? Okay, newspaper subscription, cable, things like that definitely go. I mean, gym memberships, that type of things go. I mean, eating out, some of those things go down big time when you have a recession in retail. Okay, other things you cannot change. I mean, you still have to have electricity. You still have to have. So, what are some of the? Where do you fall as a business in that environment? Let's say that you're a business to business type of organization. Okay, who are my clients? Are they telling me they're gonna honor their contracts, or they're telling me, sorry, we're not gonna take your stuff anymore. We're cutting your contract in half. And usually most of those contracts give them the ability to do that. Okay, and so what are you gonna do? What are you going to do in terms of, or they want more because they're essential and so are you? Then look at your supply chain. Am I going to be able to ramp my production to meet the demands of my customers? Okay. Is it going to cost me more? Do I have the ability to adjust the prices? What am I going to do if I'm a restaurant? Where is there a shortage in meat? What kind of non-meat dishes can I do? Or do I cut the price in proportion to the portion size? Do I start buying more disposable utensils instead of dishwashing? How is that going to affect my cost? There's more people going out of the door with the stuff and paper bags than sitting here and using my cloth napkins and my real silverware. Do I need to reduce my bus table staff and spend more money on carry out bags? A lot of it is that type of thing that you need to do by looking at what's happened in your particular industry.
It looks like that's all the questions that's come in for now.
Okay, thank you very much. Again, we are a service here at Wichita State University, KSBDC, and most of our services you're prepaid for. We are your tax dollars at work. So don't hesitate to reach out, and we can work with you on individual basis. So be well, be safe, and pay attention to your cash flow. Thank you.